Welcome to this episode of the Hidden Money Podcast. Kevin and I are excited to talk about the tax, actually the hidden money inside the tax for gig workers, for freelancers. Generally, those kind of people are always just, they're jobbing it, man. They're working hard and they're not thinking about tax. And usually when they're starting up, they're not making a lot of money, so they don't want to pay a high tax strategy fee, right?
Mm-hmm.
But almost invariably, every time we end up talking to one of these people as a prospect or on the street or our friends, man, they're paying way too much in tax, Kevin.
Yeah.
Way too much.
There's a sneaky tax that...
It's not sneaky. It's in your face.
It's in your face, but most people don't think about it.
That's right.
Because they're like, hey, I've been a W-2 employee. All they think is my employer withholds federal tax on my behalf, and then I report it on my tax return. And then you don't see the other piece on your tax return, which is FICA. It's Medicare, Social Security tax. When you're an employee, you are paying Medicare and Social Security tax. It's just you're partnering with the employer. So if you're a W-2 employee, you're paying half of your Medicare and Social Security. The employer is paying half of the Social Security and Medicare. When you're self-employed, guess what? You're paying the whole thing.
And each of those pieces is 7.65%. Employee pays 7.65%. The employer matches it. So that's 15.3%, man.
Yeah, it's a lot.
You make $100,000
on top of income.
You make $100,000 before you even assess your income taxes. You're paying over $15,000 in taxes.
Yeah, it's rough. Just right off the top, just right there, and
then you got to pay income tax.
Yep. And then what you can't do is also tax plan against that direct FICA, because you can get your taxable income down by other means, but your Schedule C or your freelance work, if you're showing income and you donate a lot to charity and try to offset some of the tax liability, you're still going to pay that self-employment tax. Even though your income tax goes down, your self-employment tax is actually calculated on the net income of your business. But there's ways to reduce and mitigate self-employment tax. You can reduce that that Social Security and Medicare tax that you pay as a independent contractor or freelancer doing your side hustles.
Yeah.
So there's ways.
But before we start getting into those ways, we're going to give you these tidbits for free. We're going to give you the hidden money for free. If you don't have the money to go pay for an expensive tax strategist, consider this. Use it. Employ it. Don't be tipping the government. Don't overpay your taxes. Mm-hmm. And invariably, most of you probably are.
Yeah. And a common, just from a budgeting standpoint, if you are self-employed and you are doing these side hustles, save for your tax. You know, if you make $100 doing a gig, I would put 24 of those dollars into a savings account. Now, everyone's different in their tax bracket, but you don't have to get so granular with it.
Yeah, I'd say start doing that once you're making over about $30,000 a year.
Yeah.
Especially if you're married, filing joint, and you're not having income from anywhere else, you're not going to pay taxes until you make well over $30,000. Mm-hmm. So you don't have to pull 25% or 24% from the beginning. But once you're getting over a certain amount, start pulling it out, and don't find yourself come April 15th when you go to a CPA or a tax preparer and they say, hey, you owe taxes, and you don't have them. And then you're paying penalties and interest. Even if you get a payment plan, you're paying penalties and interest. And penalties and interest mean you are tipping the government. You're paying more than you need to pay. I'm not going to go into the personal situation I'm currently in because of a dumb mistake I made, and I'm tipping the government. But don't do that. Learn from my mistake.
Yeah, and you know, from just a very high level, you don't want to just. You want to operate your life as a business. When you start turning self-employed, everything you touch, everything you use that helps you generate revenue or profit for your business is a tax break. So be thinking about the things in your life that you may have already purchased prior to being self-employed. You might have already bought a computer and a printer, and you might have already bought a bunch of equipment or supplies or whatever it is. A desk, a chair. Yeah, you probably already had these things. Mm-hmm. But then you turn self-employed, and now you're utilizing things that you purchased in the past for income generation on this new side job. So you can harvest those expenses that you've already paid and put them in your accounting records or start deducting them, contribute them to your LLC or however we structure it or do it. I mean, it doesn't even have to be so formal. No. But start looking at your life as a business. What are you doing that is an expense that you can reduce your taxable income? Because that is where the rubber hits the road. Is you pay income tax and you pay self-employment tax on your net income.
Yes.
Not your gross. You can bring in as much money as you want on the gross level, but if you can get creative and defendable on your expenses, you pay tax on the net after. So what are we doing in that middle ground, not in your gross revenues, but in the expenses to get our taxable net income down on our side job?
So the tax code says any reasonable, ordinary, and necessary expense you're allowed to deduct against your business. Anything you need to spend money on to grow your business, which you probably were spending money on a lot of those things anyways before you started the business, those are deductible expenses. Let's just highlight a few of them. You got a cell phone. You need that for your business. 20 years ago, the IRS didn't think that. They made you prove it. Then they realized, hey, look, you got a cell phone. Everyone needs it for business. You can deduct your cell phone expense. You need internet. You should deduct it. What are some other things?
More than likely, unless you're working at home, probably. Being a freelancer, doing side hustles, unless you're doing like Uber or something like that where it's an actual car. A lot of our freelancers are working from home. They're doing art. They are doing some sort of work at home. Well, now you have a home office and we could take that. But let's say you are an Uber driver, or I mean, those are very popular. There's people out there all the time that are Ubering as a side hustle. It's a great side hustle because you could pick up your cell phone and I want to work today, or I don't, and then you can accept it and move on, or not, or just take the night off. It's up to you. So it's really flexible. You're utilizing and using a personal vehicle that you bought. So what are we doing to track our mileage? Our cost of that vehicle, even you can pick one of two things. A vehicle deduction is very common. If you're a 1099 realtor, you're driving all over the place showing homes. If you're driving Uber, so you could do one of two things. You can either take the mileage on your vehicle, meaning you're tracking your mileage with an app, more than likely. So you're taking how many business miles and trips you're taking, comparative to how much mileage you have on the car for the vehicle for the full year. So if you drive 15,000 miles for Uber or as a realtor or whatever the case is, the IRS is going to allow you to take a certain dollar amount against that mileage. Right now, it's probably like up to 58, almost 60 cents per mile.
I haven't looked at it recently.
Yeah, so it's probably
it changes every year.
So 60 cents per mile, let's say, on $15,000. That's a huge deduction right there.
Yes.
Or you can take the actual cost of the vehicle. You can't do both, but the actual cost of the vehicle, the business use percent of the vehicle you can take as depreciation. And if it's over 6,000 pounds, even bonus. You could take wear and tear on the car, your repairs on tires, oil, gas, just your insurance, your upkeep on the vehicle. All of that's tax deductible if you're driving for Uber because your car is going to need new tires and all. I mean, that's a business expense now. So we need to pick which one, do some just quick math and see, hey, how many miles am I driving? And just Google the mileage rate for that tax year. Compared it to, how much did my vehicle cost? And can I depreciate all or some or all of my vehicle? Plus the actual expenses, and pick the higher of the two, and then that's a good tax deduction right there.
Quick thing to add, even if you're doing mileage, you can still deduct toll roads. Here in DFW, that's a big deal. It gets expensive driving around DFW, especially if you're trying to avoid traffic.
Parking and tolls.
Absolutely, parking. So you can take direct expenses, but your indirect vehicle expenses, you don't get to take. You got to take the mileage. So I would say that the main point to think about in this, and what Kevin's just saying, because I see this over and over, and I know you have, it's kind of a pain to track these expenses, much less focus, like take some of your brain capacity and focus on tracking these expenses. You're trying to make a living. You're trying to live life. But man, please consider being a good steward of what you have, what you've been given. Be a good steward of it, because that time you spend on it, in a lot of cases, can actually save you more in tax than working the extra 2 or 3 hours that you would rather do just work. It's important. So expenses tracking, doing some kind of accounting system can save you a lot of money. There's actually hidden money in doing bookkeeping for yourself, and it'll help you manage your business better. You'll see where you're making the money, what's costing you the money, how to improve cash flow. You should do that.
Yeah.
Let's get back to the FICA tax. You can't avoid a lot of it. You can't eliminate it, but you can greatly mitigate it.
Yes.
And where it adds up, again, if you're only making $20,000, $30,000 a year net income, your FICA is going to be $3,000, $4,500. When you start making $70,000, $80,000, your FICA is through the roof. The IRS offers, and tax law offers, an opportunity to mitigate that. Just because you're self-employed, someone else isn't giving you the W-2, you don't have to pay FICA on every dollar you make.
No.
Tell us about that.
Yeah, you can't, like you said, you can't completely bypass Medicare and Social Security. The government's going to require you to pay into those systems, whether you believe in them or not. Congratulations, you're paying into Medicare and Social Security. You're going to be required to, unless you have passive income. But if you're actively earning income, you're paying some sort of tax there. What happens, though, let's say you make $100,000 as a freelancer or a side hustle, and assuming that you're not capped out on your Medicare and Social Security, because you have another W-2 job or something. Let's say you're just 100% freelancer and you make $100,000.
Let me time out for a second so I can just go through the elementary basics of the FICA, because what you just said might not make sense to everyone. Everyone who's making money for a living in the United States has to pay Social Security and Medicare, whether your employer is helping you or whether you're self-employed and you're paying it. But you only have to pay Social Security on a certain amount of income. Once you get over that income, and this year it's about $170,000. With inflation, it went up a lot over the last 3 years. Your first $170,000, you're paying 15.3% if it is income subject to self-employment tax or payroll tax, right? So like Kevin said, if you have a job and you're already making $150,000 W-2, but then you go get another job or a freelance job, gets you $100,000 a year, you're not paying 15.3% on all of that. You're paying 15.3% until you get to 170. Then you're only paying Medicare, which is 2.9% for self-employment. So that's what Kevin was talking about there. I just want to throw that in.
Yeah, so you don't want to just blindly follow this advice. Always seek out a CPA, a qualified professional who can help you analyze if this is a good strategy for you or not, because everyone's different. It's hard to give blanket tax advice because everyone's different. Yes. So, but the thought is, let's say you're 100% freelancer and you are making $100,000 after your expenses. So you maybe grossed $200, you found $100,000 of expenses. So your net take home is $100 now. You're going to be paying $15,000 in self-employment tax. Then you're going to pay income tax on top of that. Well, what happens is, let's create an LLC. Hopefully you're running your business through an LLC anyway for liability. That's a different thing we can hop on. But let's say you have an LLC set up and we're running that $100,000 net income through an LLC. Now we can elect to have that LLC taxed as an S-Corp.
Still an LLC.
Still an LLC. You're not changing the formation with the state. You're not changing your EIN. You're not changing your payroll if you have it. It is a straight tax election that you make. And you're going to basically fill out, it's a form, 2553. It's an S-Corp election form. Fill that out, send it to the IRS, and you can say, I want my LLC to be taxed as an S-Corp. Now, what good does that do? Well, S-Corps are not subject to self-employment tax. So that $100,000 is not subject to that $15,300 tax of self-employment, because that's just the rules of the S-Corp. That's the benefit of an S-Corp. You only pay income tax on your net. But you can't completely bypass Medicare, Social Security. You got to play the game some. You have to. So that's where a reasonable compensation comes in. So you're actually going to put yourself on payroll of your own S-Corp. But the cool thing is, we're going to set your salary at maybe $30,000. So yes, you are going to pay some Medicare and Social Security on that first $30,000 as a salary, but then the remaining $70,000 to get you to your $100,000, that's just going to be distributions out of the LLC to you personally, a direct bank-to-bank transfer.
Still pay income tax.
Pay income tax, but no employment taxes. So your actual tax savings is 15.3% on $70,000. That is what you're saving doing an S-Corp. But also, there's analytics to be done, because now you have, if you're going to have a professional and you're going to outsource this, you're not comfortable doing a 2553. And if you're late, there's late relief. So there's a ways around everything. But if you get a professional to do this, they're going to charge you for the 2553. There now is going to be an S-Corp tax return requirement.
So you'll be filing 2 returns, not just your personal 1040.
Yep.
Now you're filing a corporate tax return.
Correct. So
and
now you
that's
have
spendy.
2 tax returns a year with a CPA probably. So now your fees are going up. Maybe by paying a CPA, but the whole thought of paying a CPA is if the CPA is doing their job, they're more strategy focused, hopefully. But every dollar you spend with a CPA is hopefully saving you more in tax. So yes, you may be paying a CPA $3,000 to $5,000 more a year, but that's going to be a lot better on that 15.3% savings on $70K. I mean, that's almost $20,000 of savings, right?
Yep. So there's a couple more caveats on there. Not only are you having to pay a CPA to file a tax return each and every year, or TurboTax and having to figure out how to do it, you got to set yourself up with payroll. And payroll is kind of a pain. If you try to do payroll, you're on your own. Figure out how to file your payroll tax returns, your W-2. You have to pay withholding now as a W-2 employer, which you are as the employee as well. You've got additional costs. I highly recommend getting a payroll service or a bookkeeper that can do it. There are ones out there that can do it. You can go almost self-service with a company like Gusto, but you're still going to have to do a good bit of work to figure it out, at least get it set up. Or you get a bookkeeper and they're doing it and talking to you about it every month or every quarter about that. So another big caveat, the IRS does not allow you to choose an S-Corp just to avoid SE tax or mitigate to SE tax. It's not allowed. And don't do it. You'll be breaking the rules, and if they find you, they're going to hit you hard. But another big problem a lot of self-employed people have is lendability. Man, it was so hard for me and Becca to buy our first home working at our firm that we were self-employed in, even though we had an LLC set up. We had a partnership return we were filing because we didn't have a Form W-2. Lenders want to see your W-2. If they hear you're self-employed, they're like, I can't count on that. But they see a W-2, you're just like everyone else that's doing conventional lending. So if you want to pay yourself an, in quote, unreasonable salary, that's an important term, that's a perfect reason to create an S-Corp. And then you also get to mitigate your SE taxes tremendously. The other thing, let's get back to this reasonable salary. In Kevin's example, he said you set your salary at $30,000, you're making $100,000, you set your W-2 at $30,000, and then you have $70,000 in distributions. That can work, and we've had a lot of clients where it works at, but you have to pay yourself a reasonable salary. The main gist of what a reasonable salary is in the tax law is what would you have to pay anyone off the street? What is the fair market price for that salary? That's a good starting point. But don't stop there.
Not reality.
That's not reality. If you're a business owner, you don't get to just pay yourself market salary. Look at you and me.
Yeah.
We didn't get market for how many years?
Yeah.
Because
cash flow wouldn't allow.
No, cash flow wouldn't allow, and we're trying to grow the business. We needed the cash not to take home. We couldn't. We needed it to reinvest in the business. We needed to be able to deal with seasonality. We had to have cash flow because if you can't make payroll, suddenly your business is out.
It's pretty rough.
If you can't pay for inventory, you're out of business. So that's a good reason. If you have a business that's like that, you get to figure that in what reasonable comp is. And there's been times where there's real, reasonable, legitimate arguments. Someone might be making $100,000 revenue, but they can't afford to pay themselves more than $6,000 that year.
Yeah.
That's aggressive. But if that's your fact, if you have a good business reason, the IRS will accept it.
Yeah. And even in the first year, they're a lot more lenient than you would think. There are reasonable compensation audits. I have not seen one in years.
6 years.
But I've been on them before. And a reasonable comp audit is, let's say you're an S-Corp making $500,000 a year. And S-Corps are very common. If you're self-employed business, not just side hustles, but if you're full-blown self-employed and you're making good money, you should probably be in an S-Corp depending on your goals and what you're holding in there. But let's say you're making $500,000. That $30,000 is not reasonable. And if you file, or in some S-Corps we get off the street or we do consults with, don't even have an officer salary.
They haven't paid themselves in 3 years.
They don't even know.
Shockingly, they haven't been audited yet.
Yeah.
They're going to be.
Because there's a specific line item on the S-Corp tax return that says officer comp. And I'm pretty sure
you, as the
that's
owner.
you. That's your reasonable comp. If there's nothing in there and your net income showing $500 and officer comp is 0, red flag.
Big.
You just have a siren on your head. So be careful. And then if you get pulled for a reasonable audit, what could happen is they could revoke your S election. They revoke your S election. Now, instead of getting S-Corp favorable tax treatment on that 500, they're going to just tax it all. All 500 subject to SE tax. Thanks for playing. I mean, don't cheat the rules.
Yes, don't cheat the rules.
Be aggressive where you can, so long as it's defendable. But there's even ways around that. So we're not going to give away all of our trade secrets, but let's say you get into an S-Corp and you haven't done a salary and it's getting to tax time. We haven't even talked about QBI maximization. But let's say at the end of the year, you just learned this. You had an S-Corp and we have 0 in our officer comp and we're making good money. There's ways to get around that red flag. There's ways that you can do it on the prep process without going back in time. I don't have a time machine, but we can go back in time and create officer salary on that tax return and make it fair for you and the government to make sure y'all are playing nice.
Yeah, so you mentioned QBI, Qualified Business Income, Section 199A deduction. It's also when it first rolled out in the 2017 Tax Cut and Jobs Act, was called the pass-through deduction. And the whole point of this, and I love this, I think it's fair. If you have a big multinational C corporation like Google, you're not paying the same tax. You're paying less of a percentage of taxes than a self-employed individual is. That ain't fair. Self-employed individuals, the startups, they need to be able to compete.
Corps are capped at 21%.
Yeah, 21%, and maybe even lower if they're domestic corps under this new tax bill. But we don't know what the bill is finally going to say. But yeah, maybe 15% if they are domestic production C corps. And you're going to be paying 37% total income tax plus 15.3% self-employment tax. That ain't fair. So to try to make that more fair, more reasonable, they came out with a QBI deduction. What the deduction basically allows you to do, and there are limitations, and Kevin's going to talk about it in a second. There's a lot of strategy you need to be thinking about in this. But you get whatever your net income is, you get a 20% deduction in the current law. Under the new tax bill so far, they're going to increase that to 23% of whatever your net income is. It's a phantom deduction. You didn't spend any money, but you get to deduct it. It is beautiful.
It's powerful.
I love things like that.
Yeah.
Depreciation, phantom deductions. Oh,
it's just a cherry on top. You don't have to remit any more cash. Nothing's going out the door. There's no risk assigned to it outside of maybe some gray area in what's called a specified service trade or business. So that's the limitation Mike hinted at earlier. It's called an SSTB. You could just Google QBI, SSTB. It'll give you a good definition of it, but the thought behind it is professional services, accountants, lawyers, doctors, people who use more consulting based for their revenue streams. They're going to be limited on the amount of QBI they can take given income thresholds and other things like that. So just be careful if you're using kind of your brain, your power to generate. You're not developing widgets, you're not selling a product, you're not out there earning income by mowing lawns or whatever. You are using your brain,
your reputation
to generate income. You might be subject to SSTB.
And if that applies to you, remember, this podcast is for freelancers and gig workers. If that applies to you, there's still possible ways, lots of ways to be able to enjoy the QBI deduction.
Let me give you a story on that, because I had a client who came in looking at their prior tax returns. They were a consultant on paper.
Yep.
But the real revenue stream was they were a life coach, but they also sold these education sources every month. So you would buy into this life coach strategy sessions or whatever.
But you got the online classes.
But she has online classes with material, handout material, PDF material, pamphlets or whatever. She developed a product that she actually sold as part of your fee to working with her. So she would consult, but she was consulting over her product. And the prior CPA just marked it SSTB. She was a specified service trade or business, which eliminated her because of her income over any QBI deduction. So I looked into it and I was just like, no, you are selling a product. You're a consultant, yes, but a lot of your revenue, 90% of her revenue, she was not consulting with every one of her clients. She had a product that she had online. People would buy the product and then they could upcharge to work with her. So that upcharge, we classified as SSTB because that's consulting. But 90% of her income was on this book or on this material she developed. That's selling of a product. And so I disagree with what the CPA did. I mean, we're talking, that was probably $150,000 deduction I mean, that's 40 grand in tax
40,
savings.
50 grand
in tax savings,
Yeah.
just by looking under the hood and not just taking the facts for the surface of what they are. So if you're a freelancer and you Google this QBI SSTB and look at it, like, man, I might be subject to it. Look at your revenue streams, because you might not be. And that's a lot of work of what we do is how do we partition income to make it eligible for more QBI deduction?
Yeah. Well, let's get back to the normal gig workers, even though we're going to have to do another one on the QBI because we've got so many cool examples. I'm just thinking about the physician during the audit that you were working with last year. They claimed they weren't eligible for any QBI, and you gave them like a $300,000 QBI.
Yep. Skated by that audit too.
That was awesome. And you nailed that audit. Yeah, you absolutely won it.
Yep.
We won it, partner.
Yes.
So
my wins are your wins. My losses are yours too.
But that person was making a couple million a year. Gig workers generally aren't making that. Hopefully you are one day, but you're not there yet probably. If you're listening to this episode, you're making under 150 probably. SSTB doesn't even matter if you're in that. The income thresholds, you have to get over them before SSTB applies. So for you guys, and if you're not working with a tax preparer, a good tax preparer and strategist, you're probably missing out on your opportunity to maximize QBI deduction. That could lower your tax by 20, 30%. Please figure that out and talk with someone or study the heck out of it. Another big issue, so QBI does have limitations even if you're only making $100,000. If you're sole proprietorship, you don't have to pay wages. If you're not, what's the problem?
If you're not paying wages as a sole proprietor?
No, let's say you have a LLC or S-Corp and you're not paying any wages.
If you're not paying any wages,
just
you're going to have
yourself.
that. Yeah, you're just going to have that red flag out there that you don't have officer comp.
Right. But also on the QBI deduction, you are limited to 50%. You can take a big deduction, but you have to have at least 50% of that deduction or in wages. Let's say you make $100,000, immediately your QBI deduction you're thinking is about $20,000.
20 grand.
You don't pay any wages, it'd be zero. Let's say you only pay $10,000 in wages. The maximum QBI deduction you can take is 50% of those $10,000 wages. But wait a second, if you're only paying yourself wages, right? In your S-Corp, the more you pay in wages, the more in self-employment tax you make. But the more you pay in wages, the bigger QBI deduction you make. How the heck do you figure that out, man?
You got a circular reference. Yeah, this is exactly why we tax plan around this exact scenario, because you're trying to balance how much wage you pay. If you're just the only employee in the business, you want to balance how much wage you pay. You don't want to pay too much. You don't want to pay too little. Too much, you're tipping with Medicare, Social Security. Too little, you're at risk for losing your election. So you want that Goldilocks just kind of right in the middle. But we recommend some of our clients, depending on what their income level is, to pay over what's reasonable. But if your QBI deduction is $20K, you got to pay double your QBI deduction in wages. So that means you need 40 grand of wages. So just think about it. Let's say you are paying self-employment tax at 15.3%.
Yeah.
Depending on what your ordinary tax tables are, you could be paying tax at 37%.
Yep.
So sometimes it's worth paying more income tax or more self-employment tax to save more on the QBI deduction, which is income tax.
But there's a fine line. I mean, there's a break-even point.
Yeah, because you cap out on your Medicare. So this could be very detailed and high level, but the point is you got to work with someone who understands this stuff because it's real money. We coach a lot. We have tax planning with clients who maybe are starting off freelancing. We go through what is ordinary and necessary deductions. Yep. We have examples of them. Then we start getting a little bit more into their situation. We kind of put our finger in this and just start stirring the pot a little bit by saying, tell us a little bit more like what you like to do. Personally, what do you do? Like, let's say you bought a short-term rental property. Is very common with where we do this. Let's say you live in Texas and you have a short-term rental property as a side gig or something that you're starting to manage some properties. Well, you might be flying out to those properties to go check on them. Well, that's an ordinary and necessary business expense for you to go check on these properties. But you're staying at the properties. So let's say you and your family go vacation at one of your rental properties, which is ordinary and necessary. You're checking on the property, but you're also staying there. So I would say that's still tax deductible. Now, you don't want to get too crazy with it. If y'all stay there 2 weeks, and you're only working
Or you
for
go
2
once
days.
a month.
Yeah. So be careful with
But
it.
if you're going up there to work on the property,
Yeah.
absolutely. If you're going up there to fix it up, to improve it, to clean it up, if you're doing the cleans and the turns, all that's ordinary necessary.
Yes, 100%. And so real estate may not be viewed as so much a side hustle or freelance work, but the thought behind it is think about what you're doing to generate income, think outside the box, and just even raise a question to a CPA who may not be in the details as much, just saying, can I deduct this? And we get that question a lot. Hey, I saw on TikTok I can do this, this, and that. Don't do that. Well, maybe, I don't know. If you have a good relationship with your CPA. I get thrown stuff sometimes that's crazy, but
I've seen some TikToks and they're like, I'm going to do this. Help me do it, Mike. And I'm like, dude,
Run.
do you want to go to prison?
Yeah.
No, we're not doing it.
Run.
Yeah.
So don't do it, but just maybe have a meeting with any CPA that's worth their weight in salt. So, and just say, here's what I'm doing on the side. Is how do I structure this? What's the best way to limit my liability, limit my tax, but maximize my deductions? What do you got for me?
Yeah. I want to talk about a side hustle that we're seeing more and more of, and I'm actually really considering doing it. Actually, I've already want to do it. I just can't get my wife talked into it because she's going to be doing most of it.
What?
We're here in South Lake Town Center, or Town Square. I'm not sure which it is. We're in South Lake. There's a Tesla dealership just down the street. I want a Cybertruck, man. I just want one, but you can't justify the expense for one. You really can't. If we turn that into a money-making business and get tax deductions out of it, it makes sense. It'll pay for itself. And then I get to drive a Tesla once in a while, a Cybertruck, without having to rent it for $400 a day, which I did once. I won't do that again. Turo is a really cool side hustle business I've seen growing and growing. Turo is like Airbnb, or it's a way for people to rent their own cars to people like Avis and Hertz did. You go buy a vehicle and you rent it out to people, you have a business. It's an ordinary necessary business. Depending on how much you use a vehicle personally versus how much you use it in the business, you also have a big tax deduction. Cybertruck happens to be over 6,000 pounds, Kevin. You can take bonus depreciation on that. You can buy a Tesla Cybertruck with 1 or 2% down, I think, get 1% interest, 1.9, I think they were offering, and pay very little for a $115,000 vehicle. If I get that, let's say I'm just using it for business for the first couple of years, and then maybe I'll take it out, buy a new car if I'm doing this in Turo. The IRS will let me deduct the entire cost of that, even if I only put $5,000 out of pocket my first year. If we're at 100% bonus, $115,000 deduction offsets my active income. That is a side hustle, but it offsets the firm income, pays for stuff. The IRS reduces my taxes by $37,000 when I put $5,000 out of my pocket, and you're making money. Yeah. Now, half of our clients I've seen doing Turo, they're not making money. Half are making a killing.
Shelter for taxes?
Yeah. Don't do it as a shelter. Don't let your tax tail wag your investment dog or your business dog. But half of them that are taking it seriously, that researched it, that took some classes, all of their vehicles are cash flowing positive. They're paying off the note. They're making cash on top of it, and they're getting heck of tax advantages. So the problem is you make me work too much at the firm and doing these podcasts and stuff. I don't have time to drive the car around to people and get it cleaned. My kids could clean it. I think that's a good job for them.
Maybe in 5 years.
Delivering it and stuff.
Yeah.
And dealing with the customers sending you messages like, how do you move the seat in the Cybertruck?
Yeah.
I sent that message.
Yeah.
They're kind of.
That's a fair warning. I had a friend. My friend has a Cybertruck. He was parked at a stoplight. His camera caught this, but this guy was just on his phone, just boom, hit the back of it, and caught it all on camera. So it's obvious. It's an obvious claim.
Right.
It took, I think, probably 4 months to get it repaired. Getting because it bent like one piece of a frame in the back, and so they had to repair this whole thing. And getting a Cybertruck repaired, no, mechanics can't work. You have to take it to the dealership. They don't have a frame.
The body is the frame.
Yes, and so repairing it is a headache. So he had a rental car for about like 3 months, gets it back, and now the value has dropped like $35,000 because now he has an accident report with a major repair on it. Even though it wasn't looking at it, it looked like just a fender bender, but because of the way it was built, it just tore it up.
I'm not letting you wave me off on that. If I'm renting it, how many people on Turo goes and do as a Carfax report before they rent a Cybertruck? I'll get the same.
Yeah, but for resale, like your value You
Well,
could be
I'm
under
hoping to take
if you
it as
owe
a
100
personal
grand
vehicle.
of debt, and then the value is worth 60K, and Turo's not working.
I
You're
hear
upside
ya.
down.
Yeah.
See, that's where
I'm
I
not
come
looking
in.
for
I'm not
resale.
risky.
I'm not looking for resale. I'm going to make money off of this thing.
Just run it. Why can't you
build
run
that.
it through the firm?
We're working
about-
on that. We have been thinking about
Yeah,
it.
thinking about it, but there's also rules of why we haven't is because, one, we're in a partnership, but we're also unequal. We're not 50-50. So if he went and bought a car and I bought a car, it's not equal because there's a percentage difference. So you got to think about that if you're in business with partners.
We need special allocations because it is a
We
partnership.
could, yeah. But also, you have to decide if it's ordinary and necessary and how much of a deduction you could get. Because Mike, if he buys a Cybertruck and we run it through the firm, that's perfectly fine, honestly. But not 100% of that vehicle is going to be for business use because
Yes.
he's not using the Cybertruck 100% for business. So he's going to get a less deduction running it through the firm than doing Turo where it's 100% profit motive.
Because you're driving it to and from work.
It's commute. for
That's
you.
the commute. If you're taking it to clients and that's all you did was driving back and forth to clients, then it could be deductible. But how do I get from home to the office? I leave the Cybertruck at the office and drive my Camry to the office each day. That's not my idea of it.
Yeah.
I hear over and over again, I just want to put, let's put this out here. I hear over and over again, wait, if I get something like a Cybertruck or an Escalade and I wrap it with my company's logo, it's an advertising expense. I can get away with deducting this thing, especially if it's over 6,000 pounds. I can get bonus depreciation. You hear that over and over. I've seen 3 TikTok videos that have been forwarded to me. I don't watch TikTok, but those are clients saying, why can't I do this?
Just wrap your car.
Yeah, why can't I do this? That's not ordinary necessary. In most cases, it is in some, and I'll talk about one in a second, but that is not ordinary necessary. It's not reasonable. And look at the tax court case history and look at audit rates on that. People lose over and over again when they've done that. And the people that told them or got paid to prepare their taxes and told them to do that, they're nowhere to be found.
Yeah.
But you're paying back all your taxes and big penalties and interest. We have a client, good friend of mine, who does, they do marketing and design. They're a really cool marketing team. They have developed a reputation of being snazzy and people that like new high tech and cutting edge. And they want to get in the design of creating car wraps. They're really good at it. So they bought a Cybertruck last year. They created this incredible wrap. I mean, they put like probably over 100 hours into creating this wrap. Both of the owners, 100 hours each into it, created this wrap, and they are taking it to each and every one of their client sales meetings when they're trying to do this wrap, and say, hey, you want a cool wrap? We can design it to your business, and we can make it sell, and it's gonna be good for SEO results and all that. That I will make an argument is ordinary and necessary, and I think if they get audited,
Doing a
we're
little
gonna
R&D
defeat
in
them.
there too.
Absolutely, man.
Yeah, that's cool. Yeah, just slapping a wrap on your car does not make it 100% either.
Or a magnet.
Oh,
right?
yeah. Otherwise, I'd go wrap my personal house. I'm like, this is a Revo house. Writing off my house. I'm just going to start writing everything off. Hey, there's my kid wrapped.
Yeah.
Go wear this T-shirt to school. Now everything related to my kid's now deductible. It's substance over form, right?
Yeah.
The form of it is you've wrapped your car, you've wrapped your kid in your house.
And it's your personal vehicle, and you're using it for everything.
You're
Taking
going to the
your kids
grocery
school,
store in
all
it.
that,
You're
yeah.
going to school events and whatnot. So, yeah, I get that all the time too. So it's always substance over form. So be careful over that. But what other deductions? I know we're kind of running short on time. But as a freelancer, or as and every industry is different. The Uber driver freelancer is going to be a lot different than the band, trying to hustle for gigs,
Right.
or writing on the side, or editing, or whatever, art. Every industry is different. But what's maybe one common deduction they could all share? And we'll wrap her up.
Meals, business meals. Almost everyone I know, especially freelancers, don't have their own office. They're out meeting people at coffee shops and for lunch to get business.
Mm-hmm.
They need to track that. The IRS says they need to write down and track contemporaneously what the purpose of the lunch was, who was in attendance, and guess what? It's a tax deduction. People don't do that. There are so many, and we don't have enough time. It would take an hour to list every single deduction that might apply to you. It all depends on your facts and circumstances, what your business does. But what Kevin and I want to reiterate, please understand this if you're a freelancer. If you haven't thought about tax strategy, you are very likely overpaying your taxes. If money's not important to you, or you love the federal government and think they're doing such an efficient job, then go ahead, keep doing what you're doing. Otherwise, track your expenses. Find out for your business what you're doing, what your facts and circumstances are. Find out what is deductible and do the work. I know bookkeeping is not sexy or fun. I hate it. I like the tax, hate the bookkeeping, but I like the tax deduction. Do it. Track your expenses, find out what's deductible, and don't overpay the government.
Yeah. To summarize everything, I mean, between Cybertrucks and S-Corps and everything, I would say, look at your life. What in your life is a business expense that's ordinary and necessary? Get as many defendable expenses as possible. Look at the S-Corp election, and then have a tax strategist or preparer actually get with you and enact and hold this tax plan to account. So that's the best I could ever offer you. And
be proactive.
Be proactive in it. Think ahead. Don't let April 15th come and bite you and have that self-employment tax looming. Save for your taxes as you go. And I tell my clients that all the time. I was like, if you're going to make $300,000 as self-employed, let's put some money into the savings account and a high yield account. Don't let it sit idle. Grow it. Then let's tax plan. And the better we tax plan, the better we do our job, the more of that account you get to keep. But let's say you do zero tax planning, a life event happened or whatever, and you're just unable to tax plan. You got your taxes saved in an account that you're in control of. You can remit your taxes, or we can plan and you can keep it. Which one do you want to do, you know?
Yeah. We always say, change your facts to change your tax. Don't be a victim to the Internal Revenue Code. Leverage off of it. Make it your best friend. Well, maybe not as much as Kevin and I love the code, but you can love it too. One more thing for this episode for the gig workers and freelancers, something that we should have mentioned and we haven't. Estimated tax. What is it? A lot of people who are starting their freelance work or new gig job, they're used to their employers taking their taxes out of their paycheck. Well, when you're your own employer, you kind of got to do that too. And I see that bite a lot of people, especially in their first year or two of business. You got to pay estimated taxes. The way our country's set up and our tax system's set up, it's pay as you go. It's not make all the money, wait till the very end of the year and then pay the government. And the way they've set that up and the way the way they prevent you from doing that is they charge you penalties and interest for not paying quarterly estimated tax that are sufficient to cover your tax obligation. Kevin, what's your rule of thumb for someone who's just getting started so they don't have to go do a bunch of hard calculations every month or every quarter? What's your rule of thumb?
I would say there's two ways you could do this. One, you could safe harbor yourself off your prior year tax. So if you're making under $450,000, somewhere in there, then you can pay 100% of your prior year tax. That's page 2 of your 1040. It'll say total tax on page 2. If you pay that in estimated payments, just take that number and divide it by 4, pay that in for the 4 quarters, then you're going to be safe harbored from any penalties. That
doesn't always work well, though, because a lot of people who are first starting freelance, they made a lot of money in their W-2. Now they're doing the risk
or you
thing
can pay
and they're making less money.
90% of current year. So you could pay 100% of prior year, which is a given number, so you can actually know what you're paying. But in the event that your income fluctuated up or down and that is not accurate, then you could do 90% of your current year income. So every dollar, I would say I'd take as a distribution. If I'm taking as much money out of my LLC or my side hustle account, if I'm taking that personally to live on, every dollar I take personally, I'm going to save a percentage, probably 20 to 25% of it into that high yield savings account, and then remit that every quarter, and stay ahead of it, and pay that way.
The hard thing with that 90% rule is you don't know what your net income is going to be for the year. It'd be really nice to know what your net income is, figure out your tax, go use a tax calculator. There's apps out there that do it. But you don't know what the future is going to hold. Yeah. It's almost an unfair tax rule, but you still got to work with it. I love when you're first starting out, Kevin's idea. You just pay 25% in SE tax.
And income tax.
Yeah, and income tax. There's other ways around it too, but for the basics, until you meet with a tax strategist or go build a cool spreadsheet on Excel, I like Kevin's idea.
Yeah, I would do it that way. A little bit more if you like to play with numbers and you're a nerd, you want to nerd out, you can always tip the government. Now listen to me, don't freak out.
I'm freaking out, man.
Don't freak out. So you could tip the government, don't pay any estimated tax payments. calculate what your penalties will be and your interest and
Okay, I'm not
everything.
freaking out.
Okay. Calculate what it would be. And so this is typically for like high income earners who may remit like $100,000 a quarter, $200,000 a quarter, whatever your income is. You're going to pay penalties if you don't pay the government, if you don't pay as you go. So maybe we accept that. Okay, I owed the government $400,000 this quarter. My penalties probably would have been 10 to 15 grand. I don't know. I'm pulling that number out. But let's say it's 10 to 15 grand of penalties you would have paid for not paying your estimated payment because you're going to pay late. Could you have invested that $400,000 and out-earned what you tipped the government? More than likely, depending on the market conditions. So we have some clients that play that game saying, I'm not going to pay the government at all. I'm not going to estimate my taxes. I'll just pay my estimated late payment penalties. I'll pay my interest. I'll pay everything I need to pay because I'm keeping my cash for myself and I'm investing it wisely, or I'm in a very good investment that I'm outgrowing what the government's charging me and I'm in control of my money. So
It's called arbitrage.
Yeah.
If you can
that's all you're
make
doing.
more by holding on and assessing the penalties, then you're arbitraging. It's free additional money. And for the people that do it right, it makes a big difference.
But you have risk. So the market could go down. You could lose on that balance, and then
Not be
you're
able to pay
really
taxes.
kicking yourself. So do so at your own risk. I'm just telling you, this is what people do and what we can advise certain people.
Yeah. Well, there you have it. There is hidden money in the tax code related to freelancing, gig economy, gig jobs. We just basically covered the surface of them. Subscribe, hit like, follow us, and learn more about this as our season unfolds.